Welcome back to the Deep Dive. Today, our mission is to give you a complete shortcut to understanding one of the most foundational companies in the whole AI revolution, Vertiv Holdings, ticker VRT.
That's right.
We have pulled apart their Q3 2025 earnings report, the call, everything, to find out exactly why this stock is so critical for assessing the health and speed of the entire AI build-out.
We are diving deep into that Q3 report, which dropped on October 22nd. And for anyone new to the space, you need to understand VRT sells the really high-density power and thermal management. I mean, this is the sophisticated cooling that keeps these massive AI data centers from literally melting down.
So if AI is the engine, Vertiv is selling the radiator and the fuel pump.
Exactly. And this report wasn't just good. It was a huge signal about capital spending across the whole hyperscale sector.
Okay, so let's unpack this with the numbers. I mean, when a stock has run as hard as VRT has, the market demands perfection. But they didn't just meet expectations. They crushed them.
They really did.
Bottom line, adjusted earnings per share, it came in at $1.24. Now think about that for a second. The street consensus was almost 25% lower, sitting between 98 cents and $1. That is a massive beat.
A clean textbook beat, and it flowed right up to the top line, too. Revenue landed at about $2.68 billion. That was comfortably ahead of the consensus, which was hovering around $2.58 billion.
And that's, what, nearly 30% growth?
29% year-over-year revenue growth. I mean, these are the kinds of numbers that should just confirm the bull thesis and send a stock flying.
Which, and this is the interesting part, brings us to the volatility paradox. Because it did soar at first. The stock jumped, 4 to 5% pre-market? It hit an intraday high of 190, 190.
Oh, okay.
But then as the day went on, it just faded. It closed down almost 2% on really heavy volume. So if the fundamentals are pristine, what causes that kind of sharp reversal?
Well, it's that tension between the amazing current results and what the market expects for the future. And, it's also about positioning. You have to remember, VRT shares had already dramatically outperformed the entire industrial sector.
Sure, it's beaten the XLI ETF by a huge margin.
By a huge margin. So the bar was set astronomically high. When results hit that bar, you get a couple of things happening. One, the short-term traders who bought into the hype, they sell into that string.
Take the quick profit.
Exactly. And two, maybe more importantly, the big institutional funds who've been building up positions, they use that spike to trim and lock in their gains. When the price hit 191, the market was basically saying, okay, we've priced in perfection for the next 6 months.
So any hint that 2026 might not be quite as explosive was a reason to sell.
That's it. It created that choppy, heavy volume fade. The dip wasn't a rejection of the quality of the earnings at all. It was more of a technical adjustment.
Which makes the quality of those results even more important to understand. So let's dig into the profitability story. Because top-line growth is one thing, but margin expansion, that shows real discipline and pricing power.
Precisely. The adjusted operating profit soared to $596 million. That's a 43% jump year over year. That flow-through is just fantastic.
And what about the actual margin percentage? How does that stack up against, other heavy industrials?
The adjusted operating margin hit 22.3%. That is a phenomenal number for a company making physical infrastructure. I mean, many traditional industrials are happy to hit the low to mid-teens.
Right.
So 22.3%, it just speaks volumes about the premium pricing VRT is commanding for these specialized high-density solutions.
And what about the trend? Was it just a good quarter or is it accelerating?
That's the key. We saw a 220 basis point improvement year over year, which is solid, but the really eye-watering number is the 380 basis point sequential improvement.
Quarter over quarter. Wow.
Yeah. That massive jump just confirms that the company is executing perfectly on a strategic mix shift. It's not just more volume, it's selling a much better, more profitable mix of products.
And what's driving that mix shift, specifically for AI?
It all comes down to physics, really. A traditional data center might need, say, 5 to 10 kilowatts of cooling per rack. But the high-performance computing for AI, training these large language models, It needs 50, 70, sometimes 100 kilowatts per rack.
Whole different ballgame.
Totally. It requires advanced liquid cooling, not just air cooling. And that technology is far more complex, much higher margin, and frankly, it's non-negotiable for the hyperscalers. VRT is right in the sweet spot to sell those premium solutions.
So that margin expansion is sustainable. It's not a one-off.
I would say so, yes. This is high-quality growth.
Okay, so if the margin story speaks to great execution today, let's talk about where this is all heading. The biggest factor for any industrial cycle is demand visibility. How fast is the line to get Vertivs equipment actually growing?
The demand story is, well, it's bordering on incredible. Organic orders grew a massive 60% year over year.
60%.
60. And even after booking all that revenue in Q3, they still saw 20% sequential growth in new orders during the quarter.
That kind of growth in a capital equipment sector just confirms the AMIS spending spree isn't slowing down. It seems like it's accelerating.
It is accelerating. And the ultimate proof is the book-to-bill ratio. It came in at roughly 1.4 times. So for every dollar of product they shipped, they added $1.40 in new orders to their future pipeline.
Demand is just outpacing their ability to deliver.
Which is a fantastic problem to have.
So let's put a hard number on that future. What's the size of the total waiting list now?
The total backlog now stands at a staggering $9.5 billion.
Wow. $9.5 billion.
Think of that as guaranteed revenue visibility stretching well into 2026. This backlog just cements VRT's position as an absolute linchpin. It's the clearest sign we have that hyperscalers are locking in their infrastructure years in advance because the pressure to build out AI is just so intense.
Okay, so beyond the pure numbers, what about strategy? What were CEO Albertazzi and Dave Coate emphasizing on the call? How are they planning to capture this momentum?
Their core message was all about scaling capacity to meet this demand. They're aggressively increasing manufacturing capacity, expanding services. They're also keeping spending high on ER&D engineering, research and development.
Stay ahead on the tech.
Exactly. To develop the next-gen cooling that will be needed for the even denser AI chips that are coming. They can't afford to give up any ground there.
Now, scaling up is one thing, but they also made a really interesting strategic acquisition, Waylay NV. Why is this more than just a simple bolt-on deal?
This might be the most fascinating part of the whole report because it's about shifting VRT's entire identity. Waylay is an AI software company. It specializes in automation, monitoring, predictive maintenance for complex systems.
So Vertivs isn't just selling a hardware box anymore.
Not at all. By integrating Waylay, they're beefing up their software layer. The goal is to drive higher attach rates. So when a customer buys a cooling unit, they also buy a high-margin, sticky software subscription to run it, optimize it, and maintain it.
And that moves their revenue from one-time CapEx to recurring OpEx.
Precisely. And we all know what recurring revenue does for a company's valuation multiple. It's stickier, it's more predictable, and it carries much higher gross margins than just selling hardware.
So they're building a technology services business on top of their industrial base.
That's the play. The Waylay deal gives them that software wedge to really accelerate the migration.
Okay, so we've got record results, huge margin expansion, a $9.5 billion pipeline, and this pivot to software. That should translate to some pretty robust forward guidance. Did management raise the outlook for the full year?
They raised it across the board for fiscal 2025. The new net sales target is now between $10.16 and $10.24 billion. That's organic growth of around 26 to 28%.
And the bottom line?
They raised the adjusted EPS midpoint to $4.10.
And what about cash? A backlog that big should be generating a ton of cash.
It is. They're projecting adjusted free cash flow to be between $1.47 and $1.53 billion. That's just massive cash generation power.
Okay, so that's the full year story. What about Q4 specifically? And did they flag any challenges?
Q4 guidance is also very strong. Sales between $2.81 and $2.89 billion, and adjusted EPS of $1.23 to $1.29. But what's really noteworthy is that management explicitly flagged potential tariff headwinds. Yet, even after calling out that significant macro challenge, they still raised the overall annual guidance.
That's a huge sign of confidence.
It's the ultimate proof point. The underlying AI demand is so robust that it's basically swallowing any macro uncertainties like tariffs that might be hurting other industrial sectors.
Okay, so if demand is that strong, and next year is basically locked in by that $9.5 billion backlog,
Yeah.
Why the anxiety? Why the sell-off that afternoon? Why is Wall Street so obsessed with 2026?
This is the absolute core of the investor debate right now. The market is just intensely focused on what the CapEx slope looks like beyond 2026. The fear is based on history.
Right, past hardware cycles.
Exactly. In past cycles like networking or the first cloud buildouts, you see this intense burst of spending and then it's followed by a digestion period.
Yeah.
The hyperscalers sort of pause to let their assets earn back their costs.
And analysts are worried that's going to happen again.
They're questioning if this aggressive pace is sustainable or if the big cloud players will slam the brakes on spending in late 2026 or 2027. So while that massive backlog gives them, maybe 18 to 24 months of certainty, it doesn't guarantee the pace of new orders 2 years from now.
It's that forward-looking anxiety, completely separate from today's amazing facts, that caused the chop.
That's it.
That makes sense. Okay, let's transition into our final segment. And as always, a critical reminder. We are guides to this material. We are not investment professionals. This is purely for educational and entertainment purposes. We are not investment advisors, and this is not financial advice.
Absolutely. But given that contradictory market reaction, selling off a spectacular beat, there is a provocative thesis here. And we would argue that Vertiv is fundamentally misclassified by the market right now.
Misclassified how?
The big institutional models are still treating VRT too much like a traditional industrial manufacturer. They're focused only on those CapEx cycles and hardware volume.
And that matters because?
It matters because of the Waylay acquisition and that margin expansion. A legacy industrial company gets a lower valuation multiple. But with the scale of that backlog and the Waylay deal giving them this immediate high-margin software wedge, VRT should be seen as an AI industrial hybrid.
So the quality of their revenue is changing faster than the market is giving them credit for.
Exactly. The software layer means their valuation multiple should be higher than what traditional consensus allows for.
Okay, so if the market has mispriced this quality shift, what's the outrageous but plausible trade idea that comes out of that?
The trade is a relative value bet. The idea is to go long VRT, betting that the accelerating margin profile blows past that $4.10 EPS midpoint again in 2026. You pair that with a short position against a pure lagging industrial manufacturer.
So a company in the XLI that has little or no AI exposure.
Exactly. You're betting on the continued bifurcation of the market where speed, connectivity, and that high-margin software attachment are prized far more than just legacy industrial scale. It's essentially an arbitrage on the speed of VRT's business model migration.
That is a fascinating way to play that margin story. So, to sum it all up, Vertiv delivered phenomenal Q3 results, crushing demand for AI infrastructure. They proved incredible operational execution with that margin expansion. And they've solidified their future with a $9.5 billion backlog.
And all while making that critical strategic pivot towards higher margin software and services with Waylay, the signal here is crystal clear. The AI build-out is accelerating, and Vertiv is running ahead of what even the bulls expected.
Which brings us back to you, the listener. Considering the stock's volatility despite these phenomenal results, how do you weigh the proven demand today, that $9.5 billion backlog against the market's anxiety over potential CapEx slowdown in 2026 and beyond? Are you buying the dip caused by short-term profit-taking, betting on management's software pivot? Or are you waiting for a clearer picture on next year's build cycle? Thanks for joining us for this deep dive into Vertiv. We'll see you next time.